We are taught from our earliest days to respect authority. The teacher in the classroom, the captain of the team, the leader on the stage. We are wired to listen, to believe, to follow. In the world of business and investing, this instinct is amplified 1,000 times. The chief executive officer, the CEO, stands at the apex of this pyramid of authority. They grace the covers of magazines. They deliver compelling keynotes. They craft eloquent letters to shareholders, painting visions of a prosperous future. We see their confidence, we hear their polished words, and our brains tell us to trust them. This, right here, is the single most dangerous trap in all of investing. It's a cognitive pitfall called the authority bias, and it has destroyed more wealth than any market crash in history. Because what Warren Buffett, the most successful investor of all time, understood decades before anyone else, is that when it comes to judging the person running a business, their words are not just irrelevant, they are a distraction. They are noise designed to appeal to our most basic instincts. Buffett's secret, the core of his entire philosophy for business analysis, is to ignore the CEO's voice entirely. He doesn't listen to the earnings calls, he doesn't get swept up in the grand strategic vision. Instead, he reads the CEO's mind. And he does it by following the one trail that can never lie, the trail of cash. The core thesis, the genetic code of this entire investigation, is that a CEO's true talent, their real character, is revealed not by the promises they make, but by the checks they write. It is revealed exclusively by how they deploy the company's capital. The decisions they make on acquisitions, on share buybacks, on dividends, on reinvesting profits back into the business, these are not just financial transactions. They are confessions. They are the pages of a CEO's secret diary written in the language of numbers. Mastering the analysis of these decisions provides an unparalleled edge, a way to see the future of a business long before the rest of the market wakes up. This is a masterclass in separating the charismatic empire builders from the quiet value creators. It is an antidote to the poison of corporate spin. We are going to deconstruct the very engine of long-term success. And in doing so, we will build a mental framework that protects you forever from the seductive lies of the corner office. Our journey begins with the foundational principle, the very bedrock of Buffett's approach, the primacy of capital allocation. Before we can analyze the specific choices a CEO makes, we must first deeply understand why this one particular job function outweighs all others. In the vast and complex machine of a modern corporation, with its thousands of employees, its intricate operations, its marketing campaigns and technological innovations, why does everything ultimately hinge on a handful of decisions about where to put the money? For most people, a CEO's job is about leadership, vision, and operational excellence, and those things matter. But in Buffett's view, they are merely table stakes. The true differentiator, the skill that separates the good from the legendary, is the role of the chief capital allocator. A CEO has 5 essential choices for the cash a business generates. First, they can reinvest it back into the existing operations. Second, they can acquire other businesses. Third, they can pay down debt. Fourth, they can return it to shareholders by repurchasing the company's own stock. And fifth, they can return it to shareholders by paying a dividend. That's it. That is the entire menu. The long-term financial fate of the company and its shareholders is determined almost exclusively by the wisdom with which the CEO navigates these 5 paths. A CEO who is brilliant at operations but a fool at capital allocation will, over time, destroy the very value they create. Conversely, a CEO who is merely competent at operations but a genius at capital allocation can create a compounding machine of immense power. This is the central insight. To truly grasp the weight of this idea, we must travel back to the 1960s and immerse ourselves in the story of a man Buffett has called the greatest manager of his generation, a man who became his blueprint for the ideal CEO, Tom Murphy of Capital Cities Broadcasting. This is not just a historical footnote. It is the foundational anecdote that shaped Buffett's entire worldview on management quality. Capital Cities was a small, unassuming company when Tom Murphy and his partner, Dan Burke, took the helm in 1966. It owned a few television and radio stations in secondary markets. It was nothing special, but Murphy possessed a rare and potent combination of traits. He was a world-class operator who squeezed every ounce of efficiency from his businesses, and he was a master capital allocator who thought like an investor. For nearly 3 decades, Murphy and Burke ran capital cities with a relentless focus on generating cash and then redeploying that cash with ferocious intelligence. They didn't chase glamour, they didn't get caught up in Wall Street fads. They operated with a simple creed. They would only purchase properties they understood, at prices that made sense, and they would finance them conservatively. They bought newspaper after newspaper, television station after television station, always with an unwavering discipline. They would never issue new shares to make a purchase, a common practice that dilutes existing shareholders. They preferred to use cash or debt, forcing themselves to be certain that the returns from the new asset would far exceed the cost of the capital used to acquire it. This disciplined approach to corporate finance was revolutionary at the time. The crescendo of their career, the deal that cemented their legend, came in 1985. Capital Cities, a company still seen by many as a collection of small-town media assets, announced it was acquiring a giant, the American Broadcasting Company, or ABC. The deal was valued at $3.5 billion, an astronomical sum at the time. It was a minnow swallowing a whale. The financial world was stunned. How could this smaller, frugal company possibly digest an iconic network like ABC? Wall Street was skeptical. But Buffett wasn't. In fact, he was more than a supporter. He was a key financial backer of the deal. He committed over $500 million from Berkshire Hathaway to help finance the acquisition, a massive bet for Berkshire at the time. Why? Because Buffett wasn't betting on ABC. He was betting on Tom Murphy. He knew that Murphy's entire career was a testament to his capital allocation prowess. He had seen the track record. While other CEOs were giving interviews, Murphy was studying financial statements. While others were building lavish corporate headquarters, Murphy was running his empire from a famously Spartan office. He was focused on the numbers, on the return on investment, on the intrinsic value of what he was buying. Buffett knew that Murphy would apply the same ruthless discipline to the sprawling, often inefficient operations of ABC. And he was right. After the acquisition, Murphy and Burke went to work. They streamlined operations, sold off non-essential assets, and focused the company on its most profitable core. They paid down the debt used for the acquisition at a shocking speed. The result was an explosion in profitability and shareholder value. A single dollar invested in capital cities in 1966, when Murphy took over, would have grown to over $200 by the time he sold the combined company to Disney in 1995. That is a staggering return, a testament not to some revolutionary product, but to decades of intelligent executive decision-making about where to put the cash. This story burned a permanent lesson into Buffett's mind. The source of extraordinary business success wasn't just having a great business, it was having a great capital allocator running it. The CEO's office, he realized, was effectively an internal hedge fund strategy, managing the capital generated by the company's operations. The reason this lesson is so critical is because our brains are actively working against us, pushing us to ignore it. The underlying psychological principle at play here is a powerful combination of authority bias and social proof. Authority bias is our deeply ingrained tendency to attribute greater accuracy and importance to the opinion of an authority figure. When a CEO, dressed in an expensive suit and speaking with utter confidence on a financial news network, lays out their 5-year plan, our brain's default setting is to believe them. We suspend our skepticism. They are the expert, the authority. This is an evolutionary shortcut that served us well when we needed to trust the tribal leader about where to find food. But it is a catastrophic liability in financial markets. The well-crafted corporate narrative, full of buzzwords like synergy, disruption, and platform, acts as a powerful sedative, lulling our analytical faculties to sleep. Compounding this is the principle of social proof. When we see that a stock is popular, that other investors and well-known analysts are bullish, we feel a powerful urge to conform. We assume that if everyone else believes the story, it must be true. The CEO's narrative gets amplified by the market's herd mentality, creating a feedback loop of belief that has little to do with the underlying financial reality. We see a rising stock price and take it as confirmation that the CEO's strategy is working, when in reality, it might just be a reflection of collective delusion. Buffett's method is a conscious, deliberate rebellion against these two cognitive traps. He short-circuits the authority bias by completely ignoring the CEO's spoken words. He doesn't care about the vision. He cares about the checkbook. He neutralizes social proof by focusing on intrinsic value, a number he calculates himself, rather than the fluctuating opinions of the market. He replaces the seductive story with the cold, hard calculus of capital allocation. He is looking for a Tom Murphy, a manager whose actions over a decade speak for themselves, not a charismatic leader whose promises are yet to be tested. He understands that talk is cheap, but capital is sacred. So how do we, as individuals seeking financial freedom, replicate this mindset? How do we build an applied mental model to put this principle into practice? The blueprint starts with shifting your entire focus from the income statement to the cash flow statement, and specifically to calculating what Buffett calls owner earnings. This is the first practical step in your journey to analyze companies like he does. The 99% of investors focus on net income or earnings per share, EPS, the numbers that get all the headlines. But these numbers are subject to all sorts of accounting manipulations. Owner earnings, on the other hand, gives you a much clearer picture of the actual cash the business is generating that the CEO can then allocate. The formula is simple yet profound. You start with net income. You add back any non-cash charges, like depreciation and amortization. Then, you subtract the average annual amount of capital expenditures the business needs to maintain its current competitive position and unit volume. This last part is key and requires some judgment. You have to look at the past 5 or 10 years of capital expenditures and estimate what portion was for simple maintenance versus what was for actual growth. The resulting number, owner earnings, is the true cash profit of the business. This is the pot of gold the CEO is in charge of. This is the capital they have to work with. Once you have this number, your analysis can truly begin. The second step in the blueprint is to become a historian of the company's capital allocation. Go back at least 10 years. Create a simple spreadsheet. In one column, list the owner earnings for each year. This is the capital that was available. In the next set of columns, track where it went. How much was spent on acquisitions? How much on share buybacks? How much on dividends? How much was reinvested into the business? How much was used to pay down debt? You are creating a financial map, a flowchart of the CEO's decisions. You will begin to see patterns. Does the CEO consistently overpay for acquisitions? Do they buy back stock only when the price is high? Do they pour money into low-return internal projects? Or do you see a disciplined, rational pattern like Tom Murphy's, where cash is deployed only when a high-return opportunity presents itself? This historical analysis is your evidence. It replaces the CEO's promises with a record of their past behavior. You are no longer listening to the story, you are reading the facts. This process transforms you from a passive consumer of corporate narratives into an active financial detective. The vast majority of investors, the 99%, take the exact opposite approach. This is the antithesis, the path of failure. Their journey begins not with a spreadsheet, but with a story. They fall into the charisma trap. They hear a dynamic CEO on a podcast or see a compelling presentation at an investor day. They get excited about the company's vision to revolutionize an industry. They are sold on the narrative. The CEO is confident, articulate, and paints a picture of inevitable success. This emotional connection forms the basis of their investment thesis. They might then look at the financials, but they do so through the lens of this positive story, a classic case of confirmation bias. They look for evidence that confirms the CEO's narrative while unconsciously filtering out any data that contradicts it. They mistake a great storyteller for a great business operator. Think of Adam Neumann at WeWork, a master storyteller who sold a vision of changing the world, but whose capital allocation decisions led the company to the brink of collapse. Or the countless biotech CEOs who can spin a beautiful tale about a miracle drug but have a decade-long track record of burning through cash with no results. The path of the 99% is to start with the story and fit the numbers to it. Buffett's path is to start with the numbers and see if they tell a story of intelligent management. The 99% outsources their thinking to the authority figure. They trust the narrative. The Buffett disciple trusts only the audited track record of capital allocation. This difference in starting points is the primary reason why most investors underperform. They are playing the wrong game. They are judging a book by its cover, while Buffett is meticulously analyzing every single page. The financial consequences of this distinction are not subtle, they are monumental. There is a direct, quantifiable connection between a CEO's capital allocation skill and the long-term return of a stock. The most powerful metric for measuring this is return on equity, or ROE. ROE is simply the company's net income divided by its shareholders' equity. It measures how effectively the company is using the shareholders' capital to generate profits. A master capital allocator like Tom Murphy will consistently make decisions that increase the company's long-term ROE. When they reinvest earnings, they do so in projects that generate returns far above the company's cost of capital, which boosts the earnings in ROE. When they make an acquisition, they do it at a price that adds more to earnings than it costs in capital, again boosting ROE. When they buy back stock at a discount to intrinsic value, they reduce the equity denominator in ROE, thus mathematically increasing the ratio. Conversely, a poor capital allocator will see their company's ROE stagnate or decline. They make a large, overpriced acquisition, and the return on that new capital is pitifully low, dragging down the company's overall ROE. They pour money into vanity projects or inefficient operations, and the earnings fail to keep pace with the capital being invested. Over time, the difference is staggering. A company that can consistently generate a 20% ROE will compound shareholder wealth at a dramatically higher rate than a company that generates only 8% ROE, even if they are in the same industry. The stock price will eventually follow this underlying reality. By focusing on the CEO's capital allocation record, you are essentially forecasting the future trajectory of the company's return on equity. You are looking at the cause, not the effect. While the rest of the market is chasing quarterly earnings and listening to stories, you are analyzing the very engine of long-term value creation. This is the ultimate financial connection. It is the bridge between a CEO's decisions and the money in your wealth management account. Having established the primacy of capital allocation, we must now dissect the single biggest, riskiest, and most ego-driven decision a CEO can make: the acquisition of another company. This brings us to our second pillar, deconstructing the acquisition machine. Mergers and acquisitions, or M&A, are the stuff of newspaper headlines and boardroom dramas. They are where legacies are made and, far more often, where shareholder value is systematically destroyed. Buffett's view on acquisitions is one of extreme skepticism. He has seen firsthand, time and time again, how the siren song of empire building can lure even the most intelligent managers into making disastrous financial decisions. He knows that for a CEO, activity is often mistaken for progress, and a big acquisition is the ultimate form of activity. It gets you on the cover of magazines. It excites Wall Street analysts. It makes the company bigger. The problem is, bigger is not always better. In fact, it's often worse. The landscape of corporate history is littered with the wreckage of value-destroying mergers. The motivation for these deals is rarely pure economics. It is often driven by a toxic cocktail of hubris, envy, and a misguided belief that one can outsmart the odds. To understand the profound danger of the acquisition game, we need look no further than Warren Buffett's own greatest mistake, a blunder so significant that he has written and spoken about it for decades as a personal cautionary tale. This is the foundational anecdote of the Dexter Shoe Company. In 1993, Berkshire Hathaway acquired Dexter Shoe for $433 million. It was a significant deal for Berkshire at the time. Dexter was a well-established, profitable shoemaker based in Maine, with a strong brand and a long history of success. On the surface, it looked like a classic Buffett investment, a durable American business with a good reputation. But this deal had a fatal flaw, a detail that would turn it from a routine acquisition into Buffett's worst deal ever, by his own admission. The flaw was not just in the price but in the currency used to pay for it. Buffett didn't pay with cash, he paid with Berkshire Hathaway stock. Specifically, he exchanged 203 shares of Berkshire A stock for the company. At the time, Buffett viewed Berkshire stock as being fairly valued, so he saw it as equivalent to paying with cash. This was a monumental error in judgment. What he failed to fully appreciate was the immense, unstoppable compounding power of the very shares he was giving away. He also failed to see that Dexter Shoe's competitive moat, its source of durable advantage, was about to be obliterated by cheap foreign imports. The business that looked so solid in 1993 was, in fact, standing on the edge of a cliff. Within a few years, Dexter's profitability collapsed. The business became worthless. Buffett eventually had to write down the entire value of the acquisition. But the pain didn't stop there. The true cost was not the $433 million he had notionally paid. The true cost was the opportunity cost of the Berkshire shares he had used. Those 203 shares of Berkshire stock, which were worth $433 million in 1993, would, over the next 2 decades, go on to be worth billions upon billions of dollars. As of today, they would be worth well over $10 billion. So, in effect, Buffett traded over $10 billion of future value for a shoe company that went to zero. He calls it his $10 billion mistake, a permanent and painful reminder of the dangers of acquisitions. The Dexter Shoe story taught him 2 critical lessons. First, even a legendary business analyst can get it wrong when assessing the future of a company. And second, and more importantly for our purposes, using your own company's stock, especially if it is a wonderful, compounding machine like Berkshire, to buy a lesser business is a cardinal sin of capital allocation. It is an act of breathtaking value destruction. This personal, painful failure informs his deep-seated skepticism every time he hears a CEO talk enthusiastically about their next big transformative acquisition. This tendency for CEOs to chase acquisitions, even when the odds are stacked against them, is rooted in a powerful psychological flaw that Buffett calls the institutional imperative. This is the underlying psychological principle that drives bad M&A. The institutional imperative is the tendency for organizations to mindlessly imitate the behavior of their peers, no matter how foolish that behavior may be. If every other company in the industry is making acquisitions, the pressure on a CEO to do the same becomes immense. To sit still and do nothing is seen as a sign of weakness, of a lack of vision. The board, investors, and the media all clamor for action. This pressure to do something often overrides a rational analysis of the deal itself. Compounding this is the CEO's own overconfidence bias. Study after study has shown that the vast majority of mergers and acquisitions fail to create value for the acquiring company's shareholders. The promised synergies rarely materialize. The challenges of integrating 2 different corporate cultures are consistently underestimated. And, most importantly, the acquirer almost always pays too much. Yet, every CEO who embarks on a major acquisition is absolutely convinced that their deal will be the exception. They believe they are smarter, their team is better, and their vision is clearer than all the others who have tried and failed before them. This combination of external pressure from the institutional imperative and internal delusion from the overconfidence bias creates a perfect storm for value destruction. The CEO becomes so focused on winning the deal, on closing the transaction, that they lose sight of the primary objective, to increase the per-share intrinsic value of their own company. Buffett's antidote to this is simple: a relentless, almost obsessive focus on the numbers, and a complete disregard for what other companies are doing. He would rather sit on a mountain of cash for years waiting for the right pitch than swing at a mediocre opportunity just to be seen as active. So how can we adopt this disciplined skepticism? We need an applied mental model, a practical blueprint for analyzing any acquisition that a company in our portfolio might make. Let's call it the M&A due diligence checklist. This is what separates a professional analyst from an amateur speculator. The first question on the checklist is, what is the expected return on invested capital, ROIC, from this deal? The CEO will talk about strategic fit and market share, but you must demand the math. How much new earnings or cash flow will this acquisition generate, and how does that number compare to the total price paid? If a company pays $1 billion for another business that will generate $50 million in annual after-tax earnings, that's a 5% return. If the company's cost of capital is 8%, that is a value-destroying deal right from the start. You must be ruthless in this calculation. The second question: how is the deal being financed? Is the company using its cash, taking on debt, or issuing new stock? As the Dexter Shoe story proves, issuing stock is the most dangerous option. It means the CEO believes their own shares are the cheapest thing they can find to buy, which is a terrible signal. A deal financed with a mountain of debt introduces significant financial risk. A cash finance deal is the cleanest, but it still has to clear the hurdle of a high return on investment. The third question: what are the integration risks? Are the two companies in completely different industries? Do they have radically different corporate cultures? The larger and more different the target company, the higher the risk that the integration will be a disaster, distracting management and destroying morale. The fourth and final question is the most important. Is this acquisition truly strategic, or is it just empire building? Is the company buying something that genuinely strengthens its competitive moat, or is the CEO just trying to get bigger for the sake of being bigger? Look at the CEO's compensation. Is it tied to the size of the company, revenues, assets, or to its per-share profitability and returns on capital? A CEO who gets paid for size has a powerful incentive to make acquisitions, whether they make economic sense or not. By systematically working through this checklist for every major acquisition, you arm yourself with a powerful filter against corporate propaganda. The 99% of investors, the antithesis of this approach, fall for what Buffett calls the synergy siren song. In almost every press release announcing a major merger, the word synergy will be front and center. It's a magical word that promises a future where 1 + 1 = 3. The acquiring company will claim that by combining operations, they can eliminate redundant costs and create new revenue opportunities, leading to a huge boost in profits. Most investors accept these claims at face value. They get excited by the big numbers thrown around, $200 million in annual cost synergies, without ever questioning how realistic they are. This is a classic mistake. Synergy is often the most expensive word in business. It is the justification used to pay a massive premium over the target company's market value. The path of the 99% is to believe the synergy story first, and only later, when the deal inevitably disappoints, to realize they were misled. The perfect tragic example of this is the AOL-Time Warner merger in 2000. It was hailed as a visionary deal that would combine old media and new media to create an unstoppable juggernaut. The promised synergies were breathtaking. The reality was a culture clash of epic proportions and a complete failure to realize any of the promised benefits. The deal resulted in the largest annual corporate loss in U.S. history and the destruction of hundreds of billions of dollars in shareholder value. Investors who believed the synergy siren song were wiped out. A disciplined analyst using our M&A checklist would have been deeply skeptical. They would have questioned the astronomical price paid by AOL, the wildly different corporate cultures, and the fuzzy math behind the synergy claims. They would have seen it not as a visionary combination, but as the peak of dot-com bubble insanity, an act of supreme managerial hubris. The financial evidence of a bad acquisition is not hidden. It is written directly onto the company's balance sheet for all to see. This is the direct financial connection. When a company acquires another for more than the fair market value of its net assets, the difference is recorded on the acquirer's balance sheet as an asset called goodwill. Think of goodwill as a placeholder, a financial ghost representing the premium paid for things like brand reputation, customer lists, and those ever-elusive synergies. In the immediate aftermath of a deal, a huge goodwill figure can make the company's balance sheet look impressively large. But it is a ticking time bomb. According to accounting rules, a company must periodically test its goodwill for impairment. If the company determines that the future cash flows from the acquired business will not be enough to justify the price paid, it must take a write-down, an impairment charge. This charge flows directly through the income statement as a massive loss. A goodwill impairment is nothing less than a public confession by management that they overpaid. It is a direct admission of capital destruction. When you see a company take a multi-billion-dollar write-down on an acquisition from a few years prior, you are witnessing the financial scar of a capital allocation blunder. By tracking the goodwill account on a company's balance sheet over time, you can create a report card for the CEO's M&A activity. A CEO who consistently adds huge amounts of goodwill that are later written down is a proven value destroyer. A CEO whose balance sheet shows little to no goodwill, or whose goodwill is attached to acquisitions that have proven to be highly profitable, is a skilled allocator. The numbers don't lie. Goodwill is the final verdict on the wisdom of an acquisition strategy. After the high-stakes drama of acquisitions, the next most significant capital allocation decision a CEO faces is what to do with the company's own stock. This leads us to our third pillar, the art of the intelligent buyback. Share buybacks or stock repurchases have become one of the most popular and most controversial uses of corporate cash. On one hand, they can be a tremendously effective way to increase shareholder value. On the other, they can be a cynical and destructive tool used by management to manipulate earnings and enrich themselves at the expense of long-term owners. Buffett's view, as always, is rooted in a simple mathematical logic. A share buyback is only intelligent if the company is buying its shares for less than their intrinsic value. If this condition is met, the transaction is a winner for the remaining shareholders. If it is not, the transaction is a loser. It's that simple. Yet this simple logic is violated every single day in corporate America. Understanding the difference between a value-creating buyback and a value-destroying one is a critical skill for any serious investor and a key part of our framework for analyzing CEO competence. To truly understand the power of an intelligent buyback program, we must turn to one of Buffett's most famous and successful investments, the Washington Post Company. This is our foundational anecdote. In the early 1970s, Buffett began buying shares in the Post, run by the legendary Katharine Graham. By 1973, he had invested about $10 million and owned a significant chunk of the company. At the time, the stock market was in a deep funk. The share price of the Washington Post, like many other companies, was languishing at a deep discount to what Buffett calculated as its intrinsic business value. The entire company had a market capitalization of around $80 million. Buffett, in his characteristically thorough business analysis, calculated that the company's assets, its newspaper, its television stations, and other properties were worth at least $400 million, and probably much more. The stock was trading at 20 cents on the dollar. It was an astonishing bargain. Buffett joined the board of the Post and became a close advisor to K. Graham. He began to patiently explain his philosophy of capital allocation. He argued that with the stock trading at such a massive discount, the single best investment the company could possibly make was in itself. Every dollar spent buying back its own shares at $80 million was, in effect, buying $5 worth of business value. No acquisition, no internal project could offer a return that high. Graham, a brilliant and open-minded leader, listened. Over the next several years, under Buffett's guidance, the Washington Post Company began a steady, disciplined program of repurchasing its own shares. They didn't shout it from the rooftops, they just quietly bought back stock in the open market whenever the price was attractive. This had a powerful twofold effect. First, it provided a floor for the stock price, as there was always a rational, price-sensitive buyer in the market. Second, and much more importantly, it dramatically increased the ownership stake of the remaining shareholders for every dollar of the company's value. As the company repurchased its shares, the ownership pie was being divided into fewer and fewer slices. Each remaining slice, including Berkshire Hathaway's, became progressively larger and more valuable. This slow, methodical process of intelligent share repurchases, combined with the excellent operating performance of the business itself, created an explosion in shareholder value over the following decades. The initial $10 million investment Berkshire made would eventually be worth over $1 billion. The Washington Post story is the quintessential example of a share buyback program executed with genius. The management, guided by Buffett, understood that the goal was not to prop up the stock price, but to take advantage of a market mispricing to increase the per-share intrinsic value for the long-term owners. The reason so many companies get this wrong is due to a set of psychological biases that affect both management and investors. The underlying psychological principle here is a combination of loss aversion and the endowment effect. Loss aversion is our tendency to feel the pain of a loss about twice as strongly as we feel the pleasure of an equivalent gain. For a CEO, seeing their company's stock price fall feels like a personal failure. It triggers a powerful emotional response. This can lead to a desperate desire to do something, to stop the bleeding. A common reaction is to announce a large share buyback program, not because the stock is objectively cheap, but as a signaling mechanism to the market, a desperate attempt to show confidence and put a floor under the price. This often leads to companies buying back stock at inflated prices, effectively lighting shareholder money on fire to soothe the CEO's ego. The endowment effect is our tendency to overvalue something simply because we own it. CEOs are not immune to this. They often fall in love with their own company and their own stock. They see it as more valuable than it really is, which can lead them to justify buybacks at almost any price. They rationalize the decision by saying, "We're investing in the best company we know," without performing the rigorous, objective valuation required to determine if the price is actually attractive. These biases lead to the most common buyback sin: companies that generate huge amounts of cash during economic booms when their stock price is high, and then use that cash to repurchase shares at peak valuations. Then, when a recession hits and their stock price plummets to bargain levels, they are strapped for cash and have to stop buying, or even worse, issue new shares at depressed prices. This is the exact opposite of what they should be doing. It is a perfect formula for destroying wealth. To protect ourselves from this folly, we need an applied mental model, a simple mathematical blueprint to evaluate any share buyback. Let's call it the buyback value test. This is a two-step process. Step 1 is to calculate a conservative estimate of the company's intrinsic value per share. You can do this using a variety of methods, like a discounted cash flow analysis based on your calculation of owner earnings, or by looking at what a rational private buyer would pay for the entire business. The exact number is less important than the process of thinking like an owner and arriving at a reasonable range of values. For example, after your analysis, you might conclude that the intrinsic value of Company X is somewhere between $100 and $120 per share. Step 2 is to compare this intrinsic value to the price at which the company is actually repurchasing its shares. You can find this information in the company's quarterly and annual financial reports. If Company X is buying back its stock at an average price of $70 per share, the buyback is highly accretive to value. For every $70 they spend, they are retiring a claim on $100 to $120 of business value. The remaining shareholders are clear winners. However, if the company is buying back its stock at $130 per share, management is guilty of value destruction. They are paying $130 for something that is only worth $100 to $120. This shrinks the intrinsic value per share for the remaining owners. It's a terrible use of capital. By applying this simple test, you can instantly cut through all the corporate rhetoric about buybacks demonstrating confidence or returning value to shareholders. The only thing that matters is the price paid versus the value received. This mental model forces you to substitute arithmetic for emotion and headlines. The path of the 99%, the antithesis, is to cheer all buybacks indiscriminately. The average investor sees a headline that says, "Company ABC announces $5 billion buyback program," and their immediate reaction is positive. They think, great, the company is buying its own stock, that must be good for the price. This is a dangerously simplistic view. They fail to ask the crucial question, at what price? They don't do the work of estimating intrinsic value. They see the buyback not as a capital allocation decision that needs to be judged on its financial merits, but as a bullish signal from management. This is exactly what many CEOs want them to think. Management often uses buyback announcements to generate positive press and goose the stock price, especially when they have stock options that are about to vest. Furthermore, buybacks, even when done at unattractive prices, can cosmetically increase earnings per share, EPS. By reducing the number of shares outstanding, the S in EPS goes down, which can make the EP part look better, even if the overall earnings of the business haven't grown at all. This can trick naive investors into thinking the company is performing better than it actually is. The 99% gets fooled by the accounting, while the disciplined analyst focuses on the economics. They celebrate the announcement, while the Buffett disciple waits to see the price paid in the 10Q filing 3 months later. The direct financial connection between intelligent buybacks and shareholder wealth is immediate and powerful. It manifests directly in the growth of intrinsic value per share. Let's run a simple scenario. Imagine a company with 1 million shares outstanding and a total intrinsic value of $100 million. The intrinsic value per share is therefore $100. The company generates $10 million in excess cash. The stock is currently trading in the market at $50 per share, a 50% discount to its intrinsic value. The CEO decides to use the $10 million to buy back shares. At $50 a share, they can repurchase 200,000 shares. Now the company has only 800,000 shares outstanding. The total intrinsic value of the business is still $100 million, but the new intrinsic value per share is $100 million divided by 800,000, which is $125 per share. In a single transaction, the CEO has increased the intrinsic value for the remaining shareholders by 25% without adding a single dollar of new earnings. This is the magic of a value-accretive buyback. Now consider the opposite scenario. The stock is trading at $200 per share, double its intrinsic value. The CEO uses the $10 million to buy back 50,000 shares. The company now has 950,000 shares outstanding. The new intrinsic value per share is $100 million divided by 950,000, which is approximately $105. Even in this scenario, EPS might go up, but the underlying value per share has been diluted. This simple math reveals the profound impact of the price paid. A good buyback program acts as a powerful accelerant to the compounding of per-share value. A bad one acts as a brake. By analyzing a company's buyback history, you can see whether the CEO has been using this powerful tool to the benefit of long-term owners or to their detriment. We have now examined the glamour of acquisitions and the mechanics of buybacks. This brings us to the most fundamental choice in capital allocation, the decision that lies at the very heart of compounding. The choice between returning cash to shareholders via dividends or reinvesting it back into the business for growth. This is our fourth pillar, dividends versus reinvestment, the great compounding debate. Every dollar a company earns belongs to its shareholders. The management team is merely a steward of that capital. So when a company generates a dollar of profit, the CEO faces a critical question. Can I reinvest this dollar within the business and earn a higher rate of return than the shareholder could earn on their own if I gave it back to them? The answer to this question should dictate the company's dividend policy. If the company has a plethora of high-return investment opportunities, it should retain every penny and reinvest for growth. If it does not, it should return the money to its rightful owners through dividends or buybacks, so they can reallocate it themselves. This seems like simple logic, but it is violated constantly. Many companies retain earnings and reinvest them in mediocre projects that earn returns below their cost of capital, slowly eroding value over time. Others pay a large dividend even when they have fantastic internal growth opportunities, starving the business of the capital it needs to realize its full potential. Finding a CEO who understands this trade-off with perfect clarity is like finding a golden ticket. The foundational anecdote that best illustrates this principle is the story of See's Candies, one of Buffett's all-time favorite acquisitions. In 1972, Berkshire Hathaway, along with Charlie Munger and another partner, purchased See's Candies for $25 million. At the time, See's was a well-loved but fairly sleepy box chocolate company based in California. It was a good business, but not a spectacular growth story. What Buffett quickly realized, however, was that See's was a truly phenomenal economic machine. The company had a powerful brand and incredible customer loyalty, which gave it pricing power. It could raise its prices every year without losing customers. And, most importantly, the business required very little incremental capital to grow. Opening a new See's store was relatively inexpensive, and the existing stores were cash-generating monsters. In its first year under Berkshire's ownership, See's earned about $2 million after tax. It required only a tiny fraction of that to maintain its operations. The rest was free cash flow, pure owner earnings. A typical CEO might have taken that cash and felt an overwhelming urge to grow the business. They might have tried to expand See's aggressively across the country, or acquire other candy companies, or diversify into unrelated businesses. This would have been a huge mistake. Buffett understood the magic of See's was its high return on the capital already invested, not its potential for massive expansion. He recognized that there were very few new places to invest that cash trees within See's that could generate the same kind of spectacular returns the existing business did. So he and Munger adopted a simple and brilliant capital allocation policy. They took the excess cash that See's generated every single year and pulled it out of the candy business and sent it back to headquarters in Omaha. They paid a huge dividend from See's to Berkshire. Over the years, See's has generated over $2 billion in pre-tax earnings for Berkshire, all on an initial investment of $25 million, and it has required very little additional capital. That $2 billion was then available for Buffett to allocate to other, more promising investments like the Washington Post, Coca-Cola, or American Express. See's Candies became the prototype for what Buffett calls a, quote, wonderful business. It was a cash cow that didn't need much capital itself, providing the fuel for Berkshire's other investments. The story of See's is the perfect illustration of a rational dividend policy. Buffett and Munger correctly identified that the shareholders, in this case Berkshire, could achieve a higher return on that capital by investing it elsewhere. So they didn't force reinvestment into low-return projects within See's just for the sake of growth. They took the cash and put it to work where it could be most productive. This disciplined decision was the key to unlocking the business's true value. The reason so many CEOs fail to make this rational choice is due to a pair of powerful psychological biases, the action bias and mental accounting. The action bias is our innate tendency to favor action over inaction, even when inaction is the more rational course. For a CEO, retaining earnings and reinvesting them is seen as taking action, as building the business. Paying a dividend can feel passive, like an admission that you have run out of good ideas. The pressure from the board and Wall Street is always to grow, grow, grow. This bias pushes CEOs to find places to spend money. Even if the expected returns are mediocre, they would rather earn a subpar 6% return on a new project than do nothing, and return the cash to shareholders who might be able to earn 10% elsewhere. The second bias, mental accounting, is our tendency to treat money differently depending on where it comes from. CEOs and boards often fall into the trap of thinking of retained earnings as the house's money, something separate and distinct from the capital that shareholders originally invested. This makes them less disciplined about how they reinvest it. They are more willing to take risks or accept lower returns with retained earnings than they would be if they had to go out and raise new capital from investors. They forget that every dollar of retained earnings belongs to the shareholders just as much as the money from the initial stock offering. Buffett's framework cuts through this fuzzy thinking. He views all capital as shareholder capital, and he demands that every dollar of retained earnings pass a strict test. Can it be reinvested at a high rate of return? If the answer is no, the action bias is ignored, the mental accounting is discarded, and the cash is sent back to its owners. To institutionalize this thinking, we need an applied mental model, a blueprint for judging a company's reinvestment policy. We will call it the reinvestment hurdle rate test. This is a practical, step-by-step process to determine if a company's management is a good steward of retained earnings. Step 1. Calculate the company's historical return on incremental invested capital. This sounds complicated, but the concept is simple. You want to see how much new profit the company has generated from the capital it has retained and reinvested over a long period, say the last 10 years. To do this, you first look at how much retained earnings have accumulated on the balance sheet and how much new debt has been added over that decade. That total is the incremental capital invested. Then, you look at how much the company's operating earnings have grown over that same 10-year period. By dividing the growth in earnings by the amount of new capital invested, you get the return the company has earned on its reinvestments. Step 2. Compare this return to the company's cost of capital. A company's cost of capital is the minimum return it must earn on new investments to create value. If the return on incremental invested capital you calculated in Step 1 is significantly higher than the cost of capital, then you have found a CEO who is a brilliant allocator of retained earnings. They are a true compounder. If the return is lower than the cost of capital, the CEO has been destroying value by reinvesting profits in subpar projects. They should have been paying that money out as a dividend. Step 3. Look at the company's current dividend payout ratio. The payout ratio is the percentage of earnings that are paid out as dividends. A company that has a high return on incremental invested capital should have a low payout ratio, retaining most of its earnings to fund its high return growth. A company with a low return on incremental invested capital should have a high payout ratio, returning the cash to shareholders. When you find a company with a high return on capital that pays no dividend, like early-stage Amazon or Google, you have found a rational growth machine. When you find a mature, low-return business that pays out most of its earnings, like a utility company, you have found a rational dividend payer. The danger lies in the mismatches, the low-return company that retains all its earnings, or the high-growth company that starves itself of capital by paying a large dividend. The antithesis of this rational approach is the growth-at-any-cost fallacy. This is the path of the 99%. Many investors and analysts are obsessed with top-line revenue growth above all else. They praise companies that are growing their sales at 20, 30, or 50% per year, without asking the critical question, what is the cost of that growth? A company can always grow its revenues by pouring more and more money into marketing, new facilities, or acquisitions. But if the return on that invested capital is poor, the growth is unprofitable. It is value-destroying growth. The dot-com bubble of the late 1990s was the ultimate example of this fallacy. Investors fell in love with companies that were growing revenues at lightning speed but were losing vast sums of money. The idea was to get big fast and worry about profits later. They praised CEOs for reinvesting every dollar they could raise, with no regard for the return on that capital. The result was one of the greatest market collapses in history, as investors finally realized that unprofitable growth is worthless. The 99% of investors are drawn to the exciting story of rapid expansion. They look at the income statement and see rising revenues and get excited. The Buffett disciple ignores the revenue line and instead performs the reinvestment hurdle rate test. They want to see profitable growth, not just growth for its own sake. They understand that a smaller, slower-growing company that generates a 25% return on capital is a far better investment than a rapidly growing behemoth that earns only 5%. The direct financial connection between this principle and your portfolio's performance is the magic of compounding, which is reflected in a company's total shareholder return, TSR. TSR is the combination of stock price appreciation and dividends paid. A CEO's decision on reinvestment directly drives this number over the long term. Let's imagine two companies, A and B, both with a book value of $100 million, and both earning $15 million a year, a 15% return on equity. Company A's CEO determines they can reinvest all $15 million of earnings back into the business at the same high 15% rate of return. They pay no dividend. Company B's CEO determines they have no good internal investment opportunities and pays out all $15 million as a dividend. Let's assume both stocks trade at book value. After 1 year, Company A now has a book value of $115 million. By earning 15% on that new, larger base, it will earn $17.25 million in the next year. Its earnings and intrinsic value are compounding internally. Company B still has a book value of $100 million and will earn $15 million again next year. The shareholder has received the dividend, but the intrinsic value of the business itself has not grown. Over a decade, Company A will have grown into a much larger, more valuable enterprise, and its stock price will have followed suit. Company B's stock price will likely be stagnant, although the shareholder will have collected a steady stream of dividends. There is no right or wrong answer here. The key is rationality. The CEO of Company A is correct to reinvest. The CEO of Company B is correct to pay the dividend. The financial crime occurs when a company that is actually like Company B, with low return opportunities, acts like Company A and retains all its earnings, leading to a stagnant ROE and poor long-term TSR. By analyzing the CEO's reinvestment decisions, you are essentially predicting the company's long-term compounding power and therefore its future total shareholder return. We have now deconstructed the 4 major capital allocation decisions. Our 5th and final pillar brings everything together. It is the practical application of our entire framework, reading the financial statements as a CEO's biography. The annual report of a company is typically a thick, glossy document. The first few pages are filled with beautiful pictures and a glowing letter from the CEO, full of optimistic prose about the company's bright future. Most people read this part and then put the report down. This is a colossal mistake. The narrative section is marketing. The real story, the unvarnished truth of the CEO's performance and character, is written in the back in the 3 core financial statements: the income statement, the balance sheet, and the statement of cash flows. Buffett has said that he reads financial statements like some people read mystery novels. He is looking for clues, for inconsistencies, for the story behind the numbers. He understands that these documents, when read correctly, are a detailed diary of the CEO's actions. Every major capital allocation decision we have discussed, acquisitions, buybacks, dividends, reinvestment, leaves an indelible fingerprint on these statements. Learning to read these fingerprints is the ultimate skill in judging management from a distance. Our foundational anecdote for this pillar takes us back to the very beginning of Buffett's career, to a moment that demonstrated his preternatural ability to find truth in numbers when the rest of the world was consumed by a panicked narrative. This is the story of the American Express salad oil scandal of 1963. American Express was, at the time, a highly respected company, but one of its subsidiaries had made a huge mistake. They had issued warehouse receipts for millions of dollars worth of salad oil held in storage tanks by a company called Allied Crude Vegetable Oil. The problem was, the tanks were mostly filled with seawater, with only a thin layer of salad oil floating on top. When the fraud was discovered, Allied went bankrupt, and American Express was on the hook for massive losses. The market panicked. The narrative was that American Express could be bankrupted by the scandal. Its stock price was cut in half. Wall Street was dumping the shares, convinced the company was doomed. Everyone was reacting to the story, a story of fraud, scandal, and ruin. But a young Warren Buffett, then in his early 30s, did something different. He ignored the headlines. He decided to conduct his own due diligence, his own business analysis. He went to restaurants and merchants and observed whether people were still using American Express credit cards and traveler's checks. He saw that the core business, the powerful consumer franchise, was completely unaffected by the scandal in the warehousing division. Then he did what he does best. He dove into the company's financial statements. He analyzed the balance sheet and the income statement. He saw a fortress of financial strength. He calculated that even if the company had to pay out the maximum possible losses from the salad oil fraud, its fundamental earning power from the credit card and traveler's check businesses was so immense that it would easily survive. The numbers told a story of resilience and profitability that completely contradicted the market's narrative of impending doom. While others were selling in a panic based on the story, Buffett was calmly buying shares based on his forensic analysis of the financials. He invested a huge portion of his partnership's capital, around 40%, into American Express stock. Within a few years, the market realized its mistake, the scandal faded, and the stock price soared. Buffett made a fortune. This formative experience cemented his lifelong belief that the financial statements, not the news headlines or the CEO's reassurances, contain the ultimate truth about a business. The psychological reason we fail to do this is the overwhelming power of the narrative fallacy. This is the underlying psychological principle. Our brains are not built to think in terms of statistics and probabilities. They are built to understand the world through stories. A compelling narrative, with a clear beginning, middle, and end, with heroes and villains, is infinitely more persuasive to us than a page full of numbers. The CEO's letter in the annual report is a masterfully crafted narrative. It tells a story of challenges overcome, of strategic triumphs, and of a glorious future. We are evolutionarily programmed to respond to this. The financial statements, by contrast, are abstract, complex, and intimidating. They don't offer a simple story. So we naturally gravitate toward the easy-to-digest narrative and shy away from the difficult-to-analyze data. This is compounded by confirmation bias. Once we have accepted the CEO's positive narrative, we will tend to interpret the numbers in a way that confirms that story. We will focus on the rising revenue line he mentioned, while glazing over the deteriorating profit margins or the exploding goodwill account on the balance sheet. Buffett's entire method is a war against the narrative fallacy. He forces himself to read the story written by the numbers first. He builds his own narrative from the financial facts. Only then, if at all, does he compare his fact-based story to the one being told by management. This inversion of the normal process is the key to his clarity. He trusts the math because it cannot be spun. It is the ground truth. So how do we put this into practice? How do we create an applied mental model for reading financials like a biography? The blueprint is to create what we'll call the CEO's report card scorecard. This is a tool you will build and maintain for every company you own or are considering owning. It's a simple spreadsheet, but it is a powerful focusing device. The scorecard should track 5 key metrics over a 10-year period, all derived directly from the financial statements. Metric 1. Return on invested capital, ROIC. This is the master metric that measures the overall profitability of the business. You will calculate and plot this number for 10 years. Is the trend up, down, or flat? This is the CEO's grade on overall business performance. Metric 2. Growth in owner earnings per share. This shows if the CEO is not just growing the business, but growing the real cash flow available to each owner. This is the grade for value creation. Metric 3. Goodwill and intangible assets as a percentage of total assets. Track this number over time. A rapidly increasing percentage is a red flag that the CEO is an aggressive, perhaps reckless, acquirer. Subsequent write-downs are a failing grade. This is the grade for M&A discipline. Metric 4. Change in shares outstanding. Track the number of shares year by year. A steady decline indicates an effective buyback program. A steady increase, especially when the stock price is low, indicates shareholder-unfriendly dilution. This is the grade for buyback intelligence. Metric 5. Debt-to-equity ratio. Track the company's leverage. Has the CEO been responsibly managing the balance sheet, or have they been piling on debt to fund risky acquisitions or buybacks? This is the grade for financial prudence. By updating this scorecard every year, you are creating a purely quantitative biography of the CEO's tenure. You are ignoring their words and grading them solely on their results. This scorecard becomes your anchor of reality, protecting you from the seductive pull of the corporate narrative. The antithesis to this, the path of the 99%, is reading the annual report like a magazine. Most people, if they look at the annual report at all, start at the beginning. They look at the nice pictures of happy employees and gleaming factories. They read the CEO's letter and get swept up in the optimistic rhetoric. They might then skim the financial highlights section, which is curated by the company to show the most flattering numbers. Then they stop. They have consumed the marketing material and mistaken it for analysis. They have allowed the CEO to frame the entire conversation. They have fallen for the narrative fallacy hook, line, and sinker. They don't even make it to the audited financial statements in the back, and if they do, their eyes glaze over at the pages of numbers. They certainly don't do the work of calculating ratios and tracking them over a decade. They are passive recipients of information. The Buffett disciple is an active interrogator of information. They know the front of the annual report is a sales pitch and the back is the evidence. They start their investigation with the evidence and use it to judge the validity of the sales pitch. This simple reordering of the process is the difference between being a sophisticated investor and being a target for corporate marketing. The direct financial connection here is the most powerful of all, the link between the story in the numbers and the company's ultimate valuation. The statement of cash flows is the ultimate tool for this. It is the final arbiter of truth. It is divided into 3 sections: cash flow from operations, cash flow from investing, and cash flow from financing. By tracing the flow of money through these 3 sections, you can see the CEO's biography written in stark relief. Cash flow from operations shows the raw cash being generated by the business. Is it strong and growing? Cash flow from investing shows where that cash went. Was it spent on huge acquisitions, a use of cash? Was it spent on new factories and equipment? Capital expenditures. Cash flow from financing shows where any extra cash came from or went. Did the company issue new debt or stock? A source of cash. Did it pay down debt, pay dividends, or buy back stock? All uses of cash. By looking at these 3 sections over 10 years, you can answer every question we have raised. You can see the cash generated, you can see the acquisitions made, you can see the buybacks executed, you can see the dividends paid, you can see the capital reinvested. It is all there. This statement is the final, undeniable record of a CEO's capital allocation choices. A company with a long history of strong operating cash flow that is used to intelligently repurchase shares or make small, bolt-on acquisitions will, over time, command a high valuation in the market. A company that shows weak operating cash flow and consistently burns money on overpriced acquisitions or ill-timed buybacks will eventually see its valuation suffer. The statement of cash flows is the ultimate link between the CEO's mind and the long-term market value of your investment. It is the final promise of the numbers. You have just journeyed through the very core of Warren Buffett's method for analyzing the person in charge. You have moved beyond the surface-level noise of charisma and corporate storytelling. You now possess the framework to judge a CEO not by the vision they sell, but by the value they build. You can deconstruct their capital allocation decisions, see through the psychological biases that lead the majority astray, and read the financial statements not as a history book, but as a predictor of the future. This is a powerful mental tool, an analytical lens that will permanently change the way you look at any business. But it is crucial to understand that Buffett's entire system is an interconnected network of these mental models. The framework for analyzing management is just one critical node in a much larger web of understanding that includes competitive advantages, valuation, and market psychology. Mastering this one piece is a monumental step, but it is still just one piece. To truly invest with the clarity and confidence of the masters, you must begin to connect these nodes, to build the full latticework of wisdom in your own mind. The video that is now appearing on your screen is not an accident. The algorithm has identified it as the next logical step in your journey. Think of what you have just learned as one piece of a map. The video on your screen is another. It is a link that connects what you now know about management analysis to another, equally critical domain of investment thinking. It holds the key to the next piece of the puzzle. The average person, the person who dabbles in knowledge, will stop here. They will feel satisfied with what they've learned and move on to something else. But you are not the average person. You have invested this time because you are on a different path. You are building an arsenal of mental tools for success. The decision to click is not just a decision to watch another video. It is a declaration. It is a choice to continue your ascent, to complete your intellectual arsenal, and to fully arm yourself for the journey toward true financial freedom. The next piece of the map is waiting. Complete it.